The business cycle. How interest rates work. To understand the business cycle, one must first understand how interest rates work in a truly free market economy. First, you have banks, and you have people who put their money in and take their money out of banks. A long time ago, if you wanted to keep your money safe, you'd put it in a bank. You'd need to pay the bank a storage fee to keep the money safe. However, banks soon realized that they could use the money that they had in storage to loan out to other people. In order to make a loan, the bank needed people's savings. Without savings, there would be no loans. The bank knew that if they wanted to encourage people to save money in their bank, they would need to pay savers a small percentage called an interest rate for the right to use their money to loan out. The bank would then charge the borrowers a slightly larger interest rate. Another way to look at money and interest rates is to think of money as any other good you would buy or sell at the grocery store, such as strawberries, and think of interest rates as the price of that good. When you want strawberries, you have to pay for them. If there are more strawberries, the price is lower. And if there are fewer strawberries, the price of strawberries is higher. So if you think of money like strawberries, if you need money, you have to pay an interest rate to receive it. If there's more money available, the price of money, or the interest rate, goes down. If there's less money available, the price of money, or the interest rate, goes up. Interest rates are thus set by the supply and demand of money. Now we've got three groups all working together harmoniously. We've got banks, we've got borrowers or producers, and we've got the savers and the consumers. As bank vaults run low, the interest rates begin to rise. So when the money starts leaving the bank, you can see the interest rates go higher. And they go higher for a reason. This is to encourage more savings, because when interest rates are higher, the savers are more tempted to put their money back into the bank. As the saver then continues to save more, he is telling the marketplace, hey, I'll spend my money later. And eventually, as more and more money gets into the bank, the interest rates begin to drop. And as interest rates begin to fall, it makes more sense for those borrowers and producers to take out loans for longer term projects. Because a small decrease in interest rates can save a company a lot of money over a longer period of time. This works out perfectly, not only because bank vaults are flush with cash to loan out, but the saver and the consumers have told the marketplace that they're deferring their purchases for a later time. Over time, as interest rates have gotten lower, the savers/consumers have slowed their rate of savings, and they've told the marketplace, hey, I'm willing to spend my money now. This again works out perfectly, because those future products are completed and ready for purchase. This is a natural system which needs no outside interference. However, what happens when interest rates are not set by the free market? Instead, what happens when interest rates are set by an all-powerful central bank? What happens when the Fed, in an attempt to spur the economy, artificially lowers interest rates? When the Federal Reserve says, hey, I need to spark the economy, they say, we've got to make interest rates low. That's the only thing we can think of. To lower interest rates, the Federal Reserve loans money to banks very cheaply. Where does this money come from that they're filling the bank vaults with? Well, the Fed just creates it. So the Fed basically fills the bank vaults with newly created money. Do you remember what happens when bank vaults are full? Well, interest rates go lower. So what do businesses think when interest rates are low? They think people have saved money, and it's a signal to start longer-term projects. Well, what do the consumers/savers think? They think, well, hey, interest rates are low. There's no reason for me to save. I'll spend my money now. Thus, the Federal Reserve has caused an obvious mismatch and has thrown a wrench in the system. These artificially low interest rates not only cause businesses to start projects they might not have otherwise have started, but it also causes new businesses to start up that might not have otherwise received loans due to their higher risk. Now, at first, you might think this is a good thing. Businesses are growing, businesses are starting up, people must be getting hired, right? Well, that may all be true, but this economic boom is an artificial boom that is not sustainable. Let's look at why. Reason number one, since consumers are not delaying their purchases and are spending their money now, businesses and consumers are competing for the same limited resources. It's possible that the resources needed to complete these longer-term projects just might not be available or would be in short supply, causing the prices to be higher. Businesses would have then underestimated the cost of the project and may not even be able to complete it. When projects can't be completed, people get laid off, and quite possibly companies go out of business. Reason number two, resources get diverted and there's an oversupply. Typically, a certain industry is favored during the artificial boom. For example, technology companies during the dot-com bubble, and any company related to housing during the real estate bubble. During these bubbles, people tend to move into careers in those favored fields, such as computer programming during the dot-com bubble. So you've got all these people moving over from one field into another field, causing an oversupply in the bubble field. Many of these people may have already had careers in another field, but changed careers because they were enticed by the inflated salaries caused by the artificial boom. This diverts these human resources away from where they may really be needed. It also causes an oversupply of potential employees in the bubble industry. As with anything, an oversupply will cause prices to drop, salaries drop. In addition, there's not enough jobs to meet the supply, and unemployment increases. Well, at some point, the Fed will see the boom in the economy and feel it needs to raise interest rates to prevent prices from rising out of control. When interest rates rise, think of all the things that happen. Consumers now begin to save more instead of spend. Those companies that relied on the spending during the bubble economy are then hurt. Companies that relied on low interest loans now have to pay a higher rate of interest on new loans. In addition, anyone who took out an adjustable rate mortgage now sees higher payments, causing them to cut back on spending elsewhere or default on their current loan. In addition, during the bubble, new companies that support the bubble industry got started and existing companies expanded. However, when the bubble economy deflates, these companies, most of which took out low-interest loans to start up or expand, now see losses. Brand new companies funded out of debt go out of business. Millions and millions of dollars invested in these companies is now lost. Think about how you would feel if the bank used your savings to fund these failed projects. In addition, you've got these banks that made these new loans that are now in trouble because people are defaulting on their mortgages, and companies can't pay back their loans. As you can see, this artificial boom created by the Federal Reserve is not sustainable. A recession soon follows. The recession is made to look like an evil that only the Federal Reserve can fix. However, the recession is the free market trying to correct things, trying to correct the problems caused by the Federal Reserve. Instead of the economy fixing itself, what does the Federal Reserve do to fix things? Well, the only thing they know how to do. They lower interest rates, which brings on a new and typically bigger bubble economy waiting to burst. Think of it this way. When the Fed sets interest rates artificially low, the economy is like a drug addict high on drugs. When the Fed takes away the artificially low interest rates and a recession occurs, The economy goes through withdrawal like a drug addict would if he stopped taking drugs cold turkey. Well, instead of letting the economy cleanse itself, the Fed lowers rates again, which is like giving more drugs to a drug addict who is going through withdrawal. This isn't a cure. It only prolongs the problem. The recession is the economy cleansing itself. While it is painful in the short term, it has long-term benefits. This is the basic premise of the Austrian Business Cycle, developed by F.A. Hayek, who won the Nobel Prize in 1974 for his work. Understanding this is critical to understanding our economy. The absolute best book you can read would be How an Economy Grows and Why It Crashes by Peter Schiff. It uses a funny and interesting story with great illustrations to teach economics in a way everyone can understand. I'd like to thank you all for watching, and please feel free to share.